Good morning, good afternoon, good evening, YouTube. Welcome back to the channel. As you can see by the title of this video, we are going to discuss at least one or two things that you should not be doing during the downturn of this market. So we all know the situation with the coronavirus, the COVID-19 that has spread throughout the different countries, and it has caused a panic here in the United States as well as other places. It has caused a panic here in the United States as well as other places, and it's really not. I really don't think people are panicking. I think it's more of the officials, the government officials, and the medical officials that are sort of panicked. And I understand you're trying not to spread the disease, but at what cost to the economy is my question. But nevertheless, the economy is down at the moment, and we are going to look at some things that you should consider when you are dealing with situations like this. So, and as has always been the case, or has most of the time been the case, this video has been inspired by a question coming from people that I know. And one of the first questions that I was asked when this thing happened was, should I move my funds into, talking about the TSP account, should I move my funds into the G fund? Okay. So we know that the G fund that's the safe fund. It's not going to lose any money. It's not going to gain any money. But if money is there, the value of that account will not go down. Okay. But let's look and see what's really happening, or what's the consequence if you do that. So here I have on the TSP website, I'm looking at the share price history. And, you open up the main page and go to investment funds, fund performance. You see share price history. And because I already talked about what you're doing when when money is coming out of your paycheck and being deposited in an account on your TSP account, it goes to purchase shares. And so the amount of shares you're able to purchase is based on the share price. Okay. So I'm just looking at the S fund and the G fund right now. Hopefully you are more diversified than that, and you have your money spread over more than one account. But for the sake of this example, to keep it simple, we're just going to look at the S fund, and we're going to say that you decided to purchase the S fund at the beginning of the year. We know last year was a good year, so at the beginning of the year, the share price started out high because everything went up last year. So you purchase shares at $56 a share, and you go through your next paycheck 2 weeks later, and you purchase it at 57. 2 weeks later, you purchase at 56, and so on and so forth. And you see that not until this past month that the share price has gone down. It's gone down with the market. And another reason I chose the S fund is because it tracks the Dow Jones Industrial Average. That's those 30 companies that I talked about, those 30 large companies. The S fund tracks them. So whatever the Dow does, you can pretty much count on your S fund account doing the same thing. So what's going to happen when you decide, you get to this point, you start to get panicked, you start to get into fear, and you don't want to lose any more money. You want to stop the bleeding. And I shouldn't say lose money. I don't like to say it that way. I like to say you don't want to lose more value in your account. You don't want the value of your account to continue to go down. You panic and you decide you want to make a change. You want to switch your S fund to the G fund. You want to transfer your S fund to the G fund. Well, what are you doing? Well, you're essentially, you bought high and sold low. And we know that goes against the investment 101 fundamental that you should buy low and sell high. So if you transfer your funds, say at $38, right? you go into the G fund. So in the G fund, your money's safe. So what happens if you decide? Well, one thing, the first thing that's going to happen is you're not going to realize a gain when the market rebounds, and it's going to rebound. We can look at historical data and see that every downturn, every stock market crash, there has always been a rebound and then some. And then over time, if you have that time to make it up, you're going to get your money back, get your account value back up to where it was, and then more because it keeps rising, right? So, but let's look at this now, and we know that it's already taking a bump up because look, 2 days ago, the share price for the S fund was $34. Now, let's say 2 days ago, you decided to transfer your funds, or even worse, cash out your account, and you sold your shares at $34 a share. So you're already down because you purchased them at 50 something dollars a share, and you're selling them low at $34 a share. Well, look what happened the very next day. Let's say it was $100,000 in the account, and you sold it, and the next day the account gained, for the share price went up $4. Okay, and you had $100,000. Well, let's say you had 1,000 shares. Well, 1,000 shares at $4 difference a share, that means you have not realized a gain of $4,000. You missed out on the opportunity for $4,000 of gain because you panicked and you wanted to sell low and you didn't wait it out. And that very next day, you could have had an additional $4,000 of value in your account. Okay, so the other thing is, your money's in the G fund. We know it's not going to move up or down. Well, what happens if you want to go back to your S fund so that you can take advantage of the stock market on the rise? Well, now, if that next day you're going to be purchasing shares at a higher price than what you had the day before. But, you're not going to do it within 1 day, but let's just say 2 weeks from now, at your next paycheck, or next month from now, when things have kind of calmed down and you want to go back to the S fund. Well, by then the S fund will probably be up. So you're going to be buying high instead of buying low. So you pretty much, I'm going to tell you what I do. I just stick with what my investment goals are. I stick with my allocations as I have them, and I'm not going to move one way or the other because of fear or thinking with my emotions, which usually leads to irrational decisions. Okay, so don't be in fear, don't be panicked. Stick to it. Let the market rebound. All those, so you can recapture those losses, and when it rebounds, you'll be sitting right back where you were, maybe even better. Okay, so that's the first thing we want to look at. Now, the other thing I want to mention was someone else approached me and informed me that someone was considering doing exactly that, or maybe even cashing out the retirement account. Cashing out the retirement account would probably be the worst thing you could do, especially if you're under the age of 59 and a half. Because if you have 401k, IRA, or TSP account, and it's a traditional account, and you are under the age of 59 and a half, then you are going to get hit with taxes at your tax rate, and you're going to get hit with a 10% penalty. So not only have you lost percentage of your investment because of the downturn, but you're also going to pile on top of that a tax rate, a deduction for taxes, and a 10% penalty. So under no circumstances should you cash out your retirement account if you're under the age of 59 and a half. Now, the next thing. So this is talking about what you should do. So stay in your investments. If it's not the TSP, if you're in stock market investments, stay in it, because as it goes down, it will also come back up. So now let's say you are like me and stock market is down. And so I want to take advantage of the stock market being down So I want to purchase more shares, um, or I want to get into the stock market on my own outside of the TSP. But in reference to the TSP, what you really want to do is maybe put more money into your S fund, your I fund, your C fund. Hopefully, you have it diversified and you're not just in one fund. Hopefully, you are spread out between at least those three. But you should be actually thinking about putting more money into it so you can purchase more shares, like like at this lower price. Because if you have let's just say a simple $100 every paycheck coming out to purchase shares. Well, up here you were only able to purchase close to 2 shares for that $100. But down here, you're going to get like 3 shares, 3 or close to 4 shares, or 2, a little over 2, close to 3 shares down here. So you have an accumulation of more shares. And so that is the key to long-term investing. And accumulating shares is what you really want to accomplish, because the more shares you have, the more money potentially you'll be able to realize the gain when those share prices go up. Okay, so now let's look at another thing. So at the beginning of the year, I said I want to invest in real estate. Well, that is on pause now. So with this downturn in the market, I say that's an opportunity for me, and there are a lot of people thinking like me because people have come to me with questions. It's an opportunity for me to go ahead and get into investing in the stock market. And we know not putting your eggs in one basket is another fundamental of investing. So your real estate investing may be one thing we can do. Investing in stocks or mutual fund is another thing we can do. We can do investment in companies, the startup companies, venture capitalist type thing. So there's other types of avenues. So we take many approaches to investing, but this is one, since the market is down, we can take advantage of. Because if we don't do it, someone else is, and they are, raking in the dough because of it. So someone asked me, what can I do to purchase stock? First thing I thought was you need to find a broker, so the broker can connect you with the company that you want to buy stock in, and you're going to have to pay them a fee. Whether their statement was, well, that means I'm going to have to pay them. Of course, that's why the broker is the professional. That's why they are there, and hopefully they have the heart of a teacher, where they can teach you everything so you understand what the strategy is and why a particular stock may be better than the other, or a particular mutual fund may be better than the other. So my decision is I'm going to definitely invest in a mutual fund, and perhaps also invest in individual stocks. Individual stocks is not thing I really was interested in before, but because the market is down, is an opportunity to take advantage of it. Okay, so before we do that, what we have to do is do a little bit of research, or what I have to do is do a little bit of research as well, because when I start looking at this stuff, there's some information on here that I just don't understand because I haven't been exposed to it. But there are some basic things we can look at. We talked about the Dow Jones. We know that the Dow Jones industrial average is 30 large U.S. companies. So if you look at, and I'm on Yahoo Finance, and if you, whatever financial website you're using, DGI will bring up is the symbol for Dow Jones. So we pull it up. It has a summary here. It shows you the 52-week range. So that's some information we can look at. I mean, it has been over the past 52 weeks. It has been as low as 18,000 and as high as 29,000. That's a pretty good range. That's a pretty good range of low to high, which is kind of what we're kind of looking for. We want to look for the lowest it's been and the highest it's been, because that can kind of give us an indication of where it could go, high or low. And on the low end, are we close to where the low is, so we know when to buy. And then on the high end, are we close to the high end to know when to sell? Buy low, sell high. Okay, then it shows you the days range. And whatever symbol you put in, you're gonna get this information. Okay. Now this is an index indicator right here, but you can click on the S&P, which is 500 companies, the NASDAQ, which contains more technology companies, and then the Russell 2000. I haven't looked at that yet, but I will be as part of my research, trying to figure out what all this stuff is. But look at the components. If you click on the components, let's say you want to invest in an individual stock, an individual company. Well, these 30 companies, large companies, well-known companies here. You have Johnson & Johnson, Verizon, Apple, McDonald's, 3M, Microsoft, Travelers, Home Depot, Walt Disney. Someone mentioned McDonald's earlier. We may look at that. Coca-Cola. These are all well-known companies. And there also shows you a cross-section of the U.S. as far as the different sectors. So you have the Boeing Company, which, of course, manufactures airplanes. Nike, that's apparel. American Express, financial, Coca-Cola, Exxon, oil and gas, Walmart, retail, Visa, that's financial, JP Morgan's financial. So you have this nice little cross section of sectors represented in the Dow Jones. Now, what you want to look at here is the share price, because how much money you have to invest will kind of dictate how many shares you'll be able to purchase. So if you go in with the goal of, I want to purchase 100 shares of McDonald's, for instance, where's McDonald's? McDonald's is here. They're at $162 a share, $163 a share. You want 100 of them. That means you need $16,000 to buy those 100 shares. Okay. Whereas more reasonable maybe Exxon's $37 a share, and you want 100 shares. Well, that's $3,700. That may be more reasonable. So that's the share price, and it shows you the change, 24-hour period. Some have gone down. Most have gone up. The Boeing company has shot up, 24% in one 24-hour period. So that's pretty good. If you had purchased 2 days ago and it's gained $31 a share, then you would have realized a 24% gain, which is good. But we want to look at long term. So let's say you want to invest in one of these companies. We'll click on, let's do, what's one that's been around a long time? Let's do Coca-Cola. Where's that at? Let's do McDonald's. So here we have McDonald's. It shows you some information here about the trading that's going on. In one day, it shows you a range. In one day, the high that it was traded at was 159. The low that it was traded at was 159, and the high was 171. But look at this, over a year, the low was 124, and the high was 221. So that's a nice spread. That's a nice spread, 124 to 221. So we can say that. Well, let's look at it. Let's look at the year to date. Okay. So at the beginning of the year, started at a high, which it should have, because 2019 was a good year, and it fell off just like most of the others. 5 year, we can see we're starting to see that trend, that walking up the stairs with the yo-yo type thing, which is what we want. And we look at the max. So we can really see it here that over time you had the ups and downs, but there has been a constant trend upwards. I didn't mean to click on that. There's been a constant trend upwards. You can see that tip right there. That's the high trading, which was 214. It should be 221. Can't get it on exactly, but it should be 221. So that's the high, which was sometime last year. Yeah, summer of last year, it was at its high. So I don't know. It's at 160. If it was maybe down 120 right now, then I would definitely consider getting into McDonald's stock. So that's my kind of thinking. I don't know if it's right. I will do some more research and try to gain as much information as I can, as to determine when to buy and when to sell, which leads me to, what else I want? Oh, let's look at McDonald's. Down here, I guess this is like a rating. They say it's overvalued, right? So at the share price right now, 162, that's overvalued, right? So that's why I say probably around the 120 is probably more reasonable, because this little tick up here is pretty recent. This little tick up here is really recent. You're talking 5 years, basically 5 years from April. It's kind of really shot up. So, I had to figure out or try to learn why. I don't know, but to me, that's kind of steering me away from wanting to purchase the stock, because it's a real sharp increase in 5 years. So, there may be something artificial to make it do that, but we'll have to find out. So, but that leads me to why I would want to purchase, or you may want to purchase, a mutual fund instead, because a mutual fund is designed to spread the risk of losses out over, not spread the risk, but it alleviate the risk of having all your eggs in one basket. Okay, so if you purchase a single stock at McDonald's, if it crashes, then that money's gone. But if you have it spread out between many companies, then one company may crash, then that doesn't totally wipe out your account, because other companies, not all the companies are going to crash at the same time. So that's why you want a mutual fund. So when I was doing research for a mutual fund, what I was looking for was growth mutual funds, and there's different categories. You have growth, aggressive growth, you have performance funds, you have balance funds, you have index funds, which are tied to the S&P 500. But what I was looking for was a growth fund that outperformed the S&P 500, because over a long period of time, the S&P 500 has averaged 11 to 12%. And that's that magic number we're always looking for, 12%. So when I did that, one fund came up. It was MSEQX. EQX, right? Which is a Morgan Stanley fund. So I was looking at it. I said, okay, share price is $43. Okay, that's not bad. I could probably get a nice amount of shares with that. It shows you their holdings, the top holdings within this particular mutual fund, right? Because I said the mutual fund consists of many companies, is made up of many companies as opposed to one company. So, and as you can see here, Amazon, Shopify, Spotify, Twitter, this is more technology kind of stocks, right? Technology kind of companies that make up this particular mutual fund. Okay, cool. So, and it shows you, some other things here. We got to figure out. I say we, so we can do it together. Show you net assets, beta, whatever that means, expense ratio, what it is, the categories, a large growth, and it shows you the inception date since 1991. So again, we want to look at the chart and see what its historical performance has been. And as you can see, since its inception, it's really had that up and down, walking up the stairs, big dip in 2008. That's understandable because of the housing market crash. And then it has a more steady, as opposed to McDonald's, it has a more steady climb upwards. Cool. So you can look at this other stuff, but one thing I want to look at was the purchase info. So when I click on that, it says the minimum initial investment is $5 million. Okay. So that is one we will not be participating in at this moment. Maybe later. But that's the kind of information you want to get on a particular fund. It shows you performance and risk, year-to-date return, 13%, 5-year average of 15.59%, which is good. That's great. 5-year average, that is great. but it's so much to get in. That's one we can't really look at now. So you have to find mutual funds based on categories. You can do a little web search. If you're looking for something performance, you're looking for something balanced, something that's not so volatile. Then you can get the symbol and put it in and look at its historical performance. And also the fund's website would also have the information. So what do you do when you want to invest? Well, I mentioned before that you can open a brokerage account, or you'd have to have a broker. Someone asked me, how do I invest in stocks? You need a broker. Well, as I've looked up the information myself, I've come to learn that you can start your own brokerage account. You may have heard of some of these companies. TD Ameritrade is one. Robinhood is one that I recently learned about. A friend of mine sent me a text, and I made sure it wasn't a scam. So I texted him back, "What is this?" And he told me what it was. TD Ameritrade is popping up over here. But also some of the big boy investment companies. Fidelity has a brokerage account. You can start a brokerage account with them. And also Charles Schwab. You can start a brokerage account with them. And these are zero commission brokerage accounts. So if you're concerned about paying someone fees or commissions, I'm sure they have some fees involved. But as far as commissions, you don't have to worry about it because there's zero commission. And if you look at other types of online or self-directed accounts, there may be a commission or some other fees involved with doing transactions. And some may have, I think I heard that some may have per transaction fees, or if you're doing like day trading type stuff, then it's like a bundle of transactions you can do without getting a fee or whatever. So you have to do all that research. So this particular fund, it shows you brokerage availability. I assume if you contacted one of these brokerage firms, they will be able to get you set up to purchase stock, this particular stock, at $5 million initial investment. Okay. Like I said, Schwab is one. Scott Trade, I've heard of that one. So all of those are different brokers, ways you can get to purchase the stock. What else? As I mentioned, the brokerage account I set up with Charles Schwab. What I had to do was attach it to a bank account, and I had to transfer funds from my bank account to the brokerage account, and that's going to be the funds I use to do my trades. Now, one thing you have to think about is it takes 3 days for that to happen. So I did it 2 days ago. So if it's not active today, it should be active tomorrow, and I will be able to actually go in there and actually make some buys or make some trades with these stocks or mutual funds. So I'm very excited about that. That's going to be fun. That's going to be very fun. So this is like an introduction for me and you to get started into investing in the market. You can look at some of these other indexes here. It's interesting that the NASDAQ, which is made of mostly technology companies, has not been able to rebound yet. So I wonder why that is. I'm gonna have to go watch some of the the business networks to see what they say about the NASDAQ. And I haven't looked at the Russell 2000 yet, but I assume that's 2,000 companies, and they always give the crude oil price, which is down as well. So oil is down, oil companies is down. They might be pretty good investments to get into them. So I'm definitely going to research those. So anyway, thanks for watching the video, everyone. And please like, share, subscribe. If you have a question or comment, please leave it down below. And we'll see you on the next one. Take care.